sake of picking long-term winners and the full lesson of index funds. The Little Book of Common Sense Investing Part 4. An investor was looking at fund rankings on his phone early in the morning. A certain fund had given spectacular returns the previous year, and he had only one question in mind. Will this be the one to change my life? He quickly thought about selling his old fund and buying the new top fund. But there was also a fear inside. What if today's winner becomes tomorrow's loser? This very curiosity unlocks the final lesson of John Bogle's entire book. The problem is not just about choosing a fund. The problem is that we mistake a past winner for a future winner. In Part 3, we saw that the market can build wealth in the long term, but fees, taxes, and excessive activity can silently eat away an investor's return. We understood that a winner's game turns into a loser's game when an investor gives up market ownership and gets trapped in high costs, frequent trading, and emotional decisions. Now, in this final part, the question is straightforward. When so many funds are available, which fund should we choose? A star manager, a top performer, or a simple low-cost index fund? John Bogle answers this in one powerful line. Don't look for the needle in the haystack. Just buy the haystack. Meaning, do not waste your time looking for a needle in a haystack. Just buy the entire haystack. In the world of investing, this means owning the entire market. If you are only focused on searching for those specific companies that will beat the index in the future, then you have entered the game of prediction. Prediction is exciting, but it is also dangerous. Because every investor is searching for that same winner, every fund manager is looking for that same best stock, and the future is not laid out open before anyone. An index fund makes this complication simple. It says that if the winner cannot be known in advance, then own the broad market so that the winners are naturally present in your portfolio as well. Bogle showed through his historical examples that very few active funds consistently beat the index over the long term. Many funds shut down, and many remain just average. There is a hidden problem here called survivorship bias. We only see the funds that survive. The ones that shut down, merged, or vanished after performing poorly are left out of the discussion. When an investor only hears the stories of successful funds, they feel that picking a winner is easy. But no one usually shows the graveyard story of the funds that shut down. Bogle says that it is very difficult to choose future winners by looking at past winners. Even fund managers do not know in advance who will truly beat the index in the coming decades. Many times a fund performs well when its size is small. But when a lot of money flows into it, executing that same strategy becomes difficult. Warren Buffett's point comes to mind here, that a large fund size can become the enemy of superior returns. Small money is flexible, while big money moves slowly in the market. When a fund becomes massive, the manager cannot easily enter or exit small opportunities. Their every move can impact the market price itself. Therefore, simply seeing that a fund did well in the past is not enough. The question is, can that same performance be repeated with a larger size, a changed market, and future uncertainty? Bogle's common sense answer is, probably not. That is why he saves the investor from the race of stock picking and manager picking, and guides them toward index ownership instead. If the chance is very low that you will identify the right long-term winner in advance, then why not choose a path where the entire market becomes your partner? This is the buy the haystack philosophy. Instead of running after a single needle, you own the entire market basket, where future winners can naturally be included. Now the final question arises, which index fund should it be? Bogle says the focus should be on the lowest cost funds, because costs are guaranteed and extra returns are uncertain. The expense ratio is that same annual cost which is deducted from an investor's money for fund management, operations, and other expenses. In active funds, the expense ratio can generally be higher because the costs of research, trading, the manager's team, and active decision-making are attached to it. In index funds, the job is relatively simple. The fund tracks a defined index, so the probability of keeping costs low is higher. But low cost does not just mean being happy by looking at a low number. An investor must also understand tracking error, fund structure, liquidity, and tax impact. Tracking error shows how closely the fund is following its index. If the cost is low but the tracking is poor, the investor will not get a result like the index. Therefore, a smart investor does not just look at the headline return. They look at the expense ratio, consistency, index quality, and their own financial needs together. Bogle's philosophy is less about the product and more about behavior. He says that investors should focus on things that are within their control. Market returns are not in your control. The next crash, the next rally, the next sector leader, all of this is not in your hands. But costs are in your control. Diversification is in your control. The time horizon is in your control. And most importantly, the decision to sell in a panic or jump in out of greed is in your control. Benjamin Graham's perspective also reinforces this very point. Graham spoke about the defensive investor, who cannot stay immersed in business analysis all the time. Most people have neither the time nor the interest to deeply understand the balance sheet management and valuation of every single company. For such investors, a diversified and disciplined portfolio is more practical. It might sound boring, but this very boring structure saves many families from financial mistakes. Graham kept the investor separate from speculation. A speculator plays on price movements. An investor stands firm on business ownership, a margin of safety, and long-term discipline. Bogle makes this idea simple in modern index investing. He says if you do not have the time to understand individual businesses, then own the broad market at a low cost. It is also necessary to understand the nature of Wall Street or the financial industry. The industry makes money from activity. The investor often saves money through inactivity. When shares are bought and sold repeatedly, brokers, managers, and platforms get revenue. But every activity is not necessary progress for the investor. This point was also visible in the story of the 𝐼𝐸 family. At first they owned the whole market and were reaping the benefits of corporate profits. Then the experts arrived, trading increased, fees increased, commissions increased, and the net return kept falling. The family had mistaken activity for intelligence. Today's investor can make the same mistake. They might run after every new theme, every hot IPO, every trending fund, and every market prediction. But wealth is often built by staying put, not by running around. A simple plan, a low-cost fund, regular investing, and a long holding period can often be much more powerful. This does not mean active funds are completely useless. Some managers can perform well and active management can be useful in certain categories. But for the average investor, the problem is one of selection. Knowing in advance which active fund will remain a winner for the next 20 years is extremely difficult. The SPIVA reports by S&P Dow Jones Indices also highlight this exact challenge. In many markets, the majority of active funds lag behind their benchmarks over a long horizon. In India too, recent SPIVA data shows that while the short-term picture can be mixed, consistently beating the benchmark over the long term is not easy. This is the reason Bogle describes the index fund not as average, but as powerful in after-cost reality. The index can give a gross average, but low costs can make the net result strong. Now let us understand the journey of the entire book together. In part 1, we learned what an index fund is and its basic difference from a mutual fund. In a mutual fund, a fund manager actively chooses companies. In an index fund, rules decide which indexes companies the money will go into. In part 2, the 𝐼𝐸 parable made it clear that when layers of experts and managers are added to whole market ownership, the total family return can shrink. In part 3, we saw how fees, taxes, and turnover slow down compounding. Even a small expense ratio can make a big difference in the long term. In part 4, the final lesson is that picking a long-term winner is not easy. Therefore, instead of searching for the needle, owning the haystack can be more practical. But a warning is also necessary here. An index fund is not risk-free. When the market falls, the index fund falls too. Volatility is always present in equity ownership. Therefore, an index fund should not be treated as a replacement for an emergency fund. Putting money meant for short-term needs into the market can force an investor to sell out of compulsion. First comes an emergency fund, then insurance, then controlling high-interest debt, and after that, long-term investing. This order is simple, but it is highly effective in financial life. An index fund is not just a product, it is a test of patience. When the market falls, the investor has to remember that they do not own a daily price but rather long-term business growth. Even when the market rises rapidly, discipline is required. Because taking unnecessary risks out of greed is just as dangerous as selling out of fear. Bogle's entire point is not that you will never make a mistake. His point is that you should build a system where the need to make a mistake is minimized. This is the beauty of a simple investing plan. Fewer decisions, lower costs, less drama, and more focus on life. Because investing is for your life, life is not for investing. John Bogle gave ordinary investors dignity. He showed that you do not need to be a Wall Street genius. You just need your fair share, and you need to understand the path to saving it. Vanguard's low-cost revolution came out of this very thinking. The idea was for the investor to keep a larger share of the market return for themselves, rather than losing it to the costs of middlemen. The final lesson of this book is very clear. Maintain broad diversification, keep costs low, keep turnover low, understand taxes, and make long-term discipline your biggest asset. If you enter the race to pick a winner every time, you too, like the 𝐻𝐸𝐺𝐥𝐸 family, might make a simple game complicated. But if you buy the haystack, meaning you become a part of the market through a broad, low-cost index fund, you step out of the prediction race. In the end, the truth of investing is not glamorous, it is peaceful. Wealth often goes to the investor who defeats their own impatience, fears, and fear before trying to beat the market. John Bogle's story concludes here. His message is simple, but it is powerful. To get your fair share of the market, you do not need extraordinary intelligence, you need common sense, low costs, and patience. So the next time someone tells you that a secret fund, a secret stock, or a secret strategy is what will build wealth, remember the 𝐻𝐸𝐺𝐥𝐸 family. Sometimes the biggest secret is that there is no secret. Buy the entire haystack, keep costs low, stick around for a long time, and let compounding do its job.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible, but in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.